there's a number of different changes. What we're going to be talking about is the delay in the overtime rules. There was a court case that came out. I'll be talking about that. Form 1095C and these also 1095B. Those were supposed to be due by the end of January. They extended it. I'll be talking about that. I'll be talking about the qualified small employer HRAs. We talked about it earlier, but I want to give you an update of what's happened or hasn't happened with that. And also what I'll be talking about is some of the unanswered questions that we're waiting for. The government has not released any guidance on that yet, so I'll be talking about that. Extend the enhanced procedures for disability benefits. They came out in January. Premium credits and delays and affordability implications of opt-out payments. Some employers are dealing with that. I'll be talking about that. The final notice on benefit and payment parameters for 2018. Court blocks enforcement of 1557 non-discrimination rules. That's extremely important. That was a very controversial ruling by HHS that said the non-discrimination requirements of ACA also apply to transgender. And what made it troublesome for some people was the fact that when the HHS came out with regulations, there was no religious exemption. So again, people filed suit against it. The court blocked it. So we're waiting to see what happens in regard to that. Also, what's happening now is certain penalties under ERISA and other sections of the federal law will be updated periodically. They just announced the updates, which I will tell you what those updated figures are. Also, I'll be talking about additional guidance issued on HRA integration. There's a lot of confusion. The IRS has come out with several things that were confusing. Now remember, under federal law, under ACA, if you're sponsoring a health reimbursement arrangement, it's got to be integrated with the group health plan. There is some question whether an employer could base the HRA on an integration from another employer's plan, especially the spouse's employer. There was some confusion in that because the IRS came out with some guidance that was kind of unclear, and they clarified that a few weeks ago. I'll be talking about the ramifications. I've gotten a lot of questions about, first, a series of Trump executive orders, what it means, what's happening. I'll be talking about that. And then in January, on January 20th, the IRS released a general counsel memorandum which has caused all kinds of issues and problems, and I'll be talking about that, on fixed annuity health plans. And these are plans that are generally voluntary. These are your AFLAC policies that pay you so much per day or so much per injury, no matter what the injury is. They may pay hospital bills of $100 a day. They may pay so much for an expense. And what many and these are voluntary plans. And to soften the blow of the premiums, what many employers are doing is that those premiums will be paid on a pre-tax basis. Well, the IRS came out and released this on January 20th and said, well, if you're going to do that, those payments, those reimbursements, if those premium payments are pre-tax, are going to be taxable when the employee receives them. Now, the issue and problem with that is, and I'll be talking about that, is many times because they're individual voluntary products, the employer may not know what the employer has received, so it's quite a dilemma. And lastly, I'll be talking about the second set of Trump executive orders. There's many sets, but the second set dealing with benefits, and I'll be talking about the impact of that. So let's get started. The first thing I'll be talking about is the delay in overtime rules. These rules were supposed to be effective as of December 1st of 2016, and the most controversial part of this is that these new regulations that were supposed to be in effect as of December 1st raised the salary levels from $23,660 that were put in place in 2004 as of December that limit was going to go up to $47,476. And none of the other rules changed. And there was all kinds of issues and problems with that because many businesses have lower level managers that are salaried that are making in the 30s or 40s, and under these new rules, if their income was below $47,476, they would have to pay them overtime. So a number of different states and also Chamber of Commerce filed a suit alleging the mechanism in the rule automatically increased the overtime threshold. There was no authority for that. And what the issue is, and especially with the election coming up, many people thought, well, when Trump gets in, he's probably going to do something to delay or either repeal the regulation, which will take months. So the December 1st date was looming. And what happened is many people, many employers raised people's salary, especially if you're making, 40, 45, you can raise it to 47, but others were starting to pay people overtime. Now with this lawsuit, there was a federal court in Texas, and the plaintiff said that the step unprecedented move by the Labor Department means stakeholders won't have a chance to provide the input before massive changes are put into place. So you have the lawsuit contending the fact there was no authority for this. You have the Trump administration coming in, and the problem is right now there is a stay. So these changes that I just indicated, going up to 47,476, we have to wait because there was a nationwide injunction. And so far, I think the hearing on this is not probably until March. So we don't know what's going to happen. But the court indicated that they thought that the Labor Department exceeded its authority. And even though this has happened before, he found that the legislation granting the Labor Department authority to do this didn't have a provision indicating salary caps. So he felt in the past that DOL has exceeded its authority. So we have to wait a few months to see what the court's going to do. Secondly, we're going to see exactly what the Trump administration, the new labor secretary, is going to do in order, because they have to go through a procedure to appeal the regulation. So it's going to be interesting over the next few months. So now, the point I'm trying to make for now, the new limit of 47,476 is stayed. The old limit of 23,660 is still in place, and we have to wait and see what the government does and also what the court does over the next few months. But again, many employers, because this particular stay happened end of November, already had raised salaries. So many employers already complied. So there's a big mess in this situation. Form 1095. Form 1095, the deadline was supposed to be to provide both the 1095B and the 1095C. The deadline to provide for employees a copy of that was originally January 31st. In November, the IRS came out with a delay. You don't need to provide those forms to employees until March 2nd. So do this as this says, to the automatic extension. No further extensions may be obtained by the application with the IRS, and the IRS will not formally respond to any request for any extensions. So employees, instead of having to be provided by January 31st has been delayed to March 2nd. Now, what's interesting about this IRS pronouncement is that they did not delay the due date that's filed with the Internal Revenue Service. So if you're filing the forms, the 1095B and the 1095C paper, they're due by February 28th. Yes, it seems kind of strange before you have to give it to the employees. If you're going to file electronically and you have you're required to file it electronically if you're filing 250 or more Form 1095s, but if you're smaller, you can do it. And that's not due until the end of March. Now, filers, if they can't meet the deadlines to file with the Internal Revenue Service, they can file for an extension using Form 8809, and they can be granted a 30-day extension. So you have to file it by the before the regular due date. Now, what's also very important is this next slide. Good faith compliance. When these forms were filed for 2015, the IRS had indicated if you make a good faith compliance, if you file them, and if there's mistakes in them, don't worry, you're not going to be penalized. So as this slide indicates, no penalties will be imposed on entities that report incorrect or incomplete information. They will give you time to correct it. So as long as you make a good faith effort. So this was applicable for 2015. This notice that came out in November, extended it to 2016. So again, a good faith effort still applies for 2016, but the penalty relief, as this slide indicates, is not available to entities that fail to furnish statements or file returns, miss applicable deadlines, or otherwise not make a good faith effort. So try to meet the deadlines, even if you're unsure of the information. Still file them, and they'll give you the benefit of the doubt. Extremely important. At first, the IRS wasn't going to do this, and they decided to extend this good faith effort extension to 2016. Qualified small HRAs. This is part of the 21st Cures Act that was passed by Congress and signed by the President in December of 2016. It's supposed to be effective for plan years beginning on or after January 2017. I talked about this earlier in a seminar talking about HRAs. It's a special exception for an employer to qualify. Only an employer that employs less than 50 full-time employees and full-time equivalents, so they're not an applicable large employer. Also, they can't be sponsoring a group health plan, and they must offer the HRA to all eligible employees. Again, you can't just offer it just to a small group of employees. It's got to be everyone. Now, what you can do, you can exclude certain employees. These include those that haven't worked 90 days, are part-time, that's less than 35 hours, or seasonal employees that work less than 9. Now, if you look at this and are confused, these are the definitions from the rules under 105H, not from ACA, so they're different. You can also exclude employees under age 25, union employees, and certain non-resident aliens. So everyone else that that is working for you, that is full-time, has to be eligible to receive a reimbursement. The reimbursement is for if you have single coverage, is if you don't have any dependent, is $4,950. For family, it's $10,000, and it's prorated for employees who don't work the full year, and I think it's based on a plan year. Now, this just includes employer contributions. There's no salary reduction included in this, and under certain conditions, the employer can vary the contributions. The employer can vary the amount of the reimbursements available under the arrangement based on age of the eligible employee and family members, the arrangement, if the family arrangement covers family members or the number of family members. So you can do some variance in which you do reimburse. But any variation must be in accordance with the variation in price of the insurance policy. Because remember, in the small plan market, it's based on age. And for this purpose, any variation may be determined in reference to the same insurance policy with respect to eligible employees. Now you can reimburse either premiums or Code Section 213 medical expenses. Now, the problem with this is we have no guidance, so I've been unable to draft these plans. So you can reimburse individual premiums or expenses. So we don't know at this point where they're going to draw the limits on reimbursing. Well, can you reimburse Medicare premiums? We don't know yet. Can you reimburse premiums, for example, from another employer's plan? I don't know. I don't think so, but there's no guidance on that. All right. Now, to receive a tax-free reimbursement, the employee must show proof that they are covered under a minimum essential coverage when enrolling. After enrollment, the employer must provide the following as proof of continued coverage: explanation of benefit, EOB, indicating that it wasn't covered by a plan, or a monthly premium bill showing that they do have coverage. So one of the requirements of this plan is the fact that you have to show evidence of the fact either you have an expense that's not being reimbursed, or that you have an expense that's not being paid by the plan. Now, participants may be taxed on the reimbursements if the participant is not covered by their minimal essential coverage for any month during the year. So you can't just have the employer reimburse an expense while not showing evidence that you have coverage. Now, what you also have to do, an employer must provide an annual written notice 90 days in advance of the plan year or the employee's eligibility date, and this notice must contain the amount of HRA benefits available, instruct the employees to provide the amount of HRA benefit available, warn employees that their reimbursements may be taxable if the employees do not have minimal essential coverage, and the failure to provide this notice will trigger a penalty of $50 per employee up to a maximum of $2,500. Now, the downside of this plan is the fact that it can affect whether an employee is going to be eligible for credits and subsidy. So as this slide indicates, an employee who is provided the HRA is not eligible for premium tax credits if the HRA is deemed to be affordable. And the affordability for this purpose is computed in a manner similar to other employer coverage. So again, it could affect with the employees the amount of the exact credit if it's determined that the HRA is affordable. So please warn employees about this. Now, as I indicated before, since this was signed into law in December, late December of 2016, the only thing that the IRS has released is a series of question and answers which didn't go in any detail. So we don't know at this point what the document's going to look like, because there are some differences between this HRA and other HRAs. For example, this HRA is not subject to COBRA, so we don't know whether, and basically what the legislation said was the fact that this HRA will not be considered a medical plan for ACA purposes. So there's some differences between this HRA and the HRAs that we're used to in the past. So stay tuned. Hopefully they're going to release guidance very quickly on this. And so at this point, I haven't drafted any documents because I'm waiting for guidance.
All right.
So Amanda, do we have any questions so far?
Yeah, I was just about to ask to pause here because we have quite a few about HRAs. But before that, we have one about ACA. Do you think the IRS will come up with a list of do's and don'ts on the Form 1095-Cs submitted by employers? I'm looking forward to feedback from the IRS on the forms that were submitted in 2015 and the ones for 2016.
They've released stuff on occasion. The biggest issue and problem in 2015, and hopefully employers have solved this, is that employers discovered after the forms were filed with Internal Revenue Service that some of the employees didn't have correct Social Security numbers. And all these employees have gone through to I-9s and W-2s, and all of a sudden, and so hopefully employers have tried to solve that issue. But in regard to others, the problem in the situation is these forms are extremely complicated. And I'll be talking about this in the next few minutes. Trump came out and indicated that agencies should soften the blow of ACA by waiving any penalties. And many people thought that the IRS was going to come out and waive the penalty for filing the 1095-Cs. So far, nothing has happened so far, and the deadlines are coming due. So what I would suggest, try to do the best you can. Make sure you provide these forms when you're supposed to, because so far none of the penalties have been, or any further guidance has been released on this. So try to do the best you can. But everybody realizes this is an extremely complicated form to fill out.
Mm-hmm. And you'll be receiving information in the follow-up email about our ACA solution as well, in case you have any questions about how to file that way. Our next question.
Many people thought, many people thought because Trump was elected, all this stuff was going to go away immediately. That's not the case.
Nope. All right. So would this HRA be okay for a self-employed company of one?
Yes.
Okay. Can you offer this to part-time employees, or must it only be full-time employees?
You can be more generous. You can be more generous, but when you start opening up the categories, basically you can't pick and choose within that category to cover. You have to, if you're going to include some part-timers, then you have to include all part-timers.
Okay. Can you have classes for the HRA, such as paying more for executives?
No.
Okay. And can an employer provide and pay for MEC plans for the employees with the HRA for minimum essential coverage?
Yeah, for premiums, but it's got to be individual coverage. That's the problem. So it's got to be at least minimum essential coverage. If somebody wants to get a more expensive plan, no problem. And the limits are what they are for both individual coverage and for family coverage.
Okay. That's all for now. That was the last question I had on here.
Okay. Let's go on to extended enhanced procedures for disability programs. If you're insured, this is going to be handled by the insurance companies, but you should know that new rules came out in regard to disability benefits. So denial notices must explain the reason for not following the disability determination made by Social Security. So the insurance company, and again, if you buy an insured plan, the insurance company makes a decision on whether to provide the benefits, and that definition of disability may be different than Social Security Administration. So again, denial notices must explain the reason for not following the disability determination made by Social Security, but in a change from the proposed regs, no explanation is needed for not following determinations of other disability benefit payors. So denial notices must discuss the basis for disagreement with the advice obtained on behalf of the plan from medical or vocational experts, and a requirement as added, and the requirement added a requirement that a notice of denial on appeal must describe the plan-imposed deadline for filing the lawsuit. So remember, under ERISA, once a benefit is denied and the plan doesn't pay the benefits, then the employee under ERISA can sue the plan. But what they can do, what the employer can do is say, okay, if you're going to sue us, you have to sue us within a designated period of time. They can put a limitation on that. And that is, again, permittable. And that's what indicates. You have to put that as specified expiration date there. So reflecting comments noting the vocational experts often play a role similar to medical and healthcare professionals in analyzing disability claims, the final regulations add vocational experts to a list of individuals that may be insulated from conflicts of interest, And the preamble notes that the need for independence and impartiality is not limited to final decision makers, rather it includes all others that support. So again, it gives some cover to others that are given advice in the situation. Premium credits and delays in affordability. Okay, so the final regulations here clarify and expand the existing exception for affordability requirement for an employee intentionally or recklessly disregarding the facts in providing information. What this slide is trying to say is if the exchange discovers the fact that somebody lied to them about what coverage they get, they can impose intentional and reckless disregard standard and deny credits and subsidies if the employees lied. What this slide is trying to say, the exception to that is if the employer gave the employee wrong information, then the employee will not be held responsible for that. Next, employees are considered eligible for affordable minimal essential coverage on the employer plan and are ineligible for credits if they have an opportunity to enroll. And this is important because the fact that if in a situation, if there's no evidence the employer gave the employee the opportunity to enroll, then that employee will be eligible for credits and subsidies. So individuals who decline to enroll in employer-sponsored coverage are considered eligible for coverage only for the remainder of that plan year, so every 12 months. And if you're not provided another opportunity to enroll at the end of the plan year, they are no longer considered eligible for employer coverage and therefore eligible for premium credits and subsidies. So what some employers did in the past, when you entered employment, you were given an opportunity to enroll in coverage. If after that they said once you've waived coverage, you can no longer come back again, that practice again is no longer viable. And what these slides are trying to say is every year an employee has to be given an opportunity to enroll in coverage. Now, there are situations where individuals to waive coverage were given an opt-out payment. In guidance in Notice 2015-87, the IRS said in there that in order for that opt-out payment not to be considered for affordability purposes, it must be conditional, which means that I will only give you the opt-out payment if you show me evidence of other coverage, either through the exchange or individually or through another employer. If you give me that evidence of other coverage, then that opt-out payment, whatever it is, will not be counted for affordability purposes. And what this guidance from the Internal Revenue Service said, we're not going to apply that standard. It was supposed to run out by the end of 2016. They're going to extend it to the end of 2017. So currently, opt-out payments are not considered for affordability purposes until they come out with final regulations. That's what that is trying to say. Final notice of benefit and payment parameters for 2018. The IRS increased maximum annual limits and cost sharing to $7,350 for individual coverage and $14,700 for family coverage. That's compared to $7,150 for individual coverage and $14,300 in 2017. So these new limits are for 2018. Also, the IRS added an exchange standardized bronze plan that is HSA eligible, but they didn't do it for other levels. Now, this next one is a very interesting provision. Let me explain what it is. Section 1557 of the ACA. This provision indicates that no employer can discriminate for age, race, or sex. The HHS took that position to say, okay, sex means transgender procedures. And what's interesting about this is the fact that, and this is Section 1557 prohibits discrimination in certain health programs and activities basis of race, color, national origin, sex, age, and disability. And I said HHS came up with regulations that said sex means transgender procedures. Now, what's interesting about this section, it only applies for those entities that get payments from HHS, which means Medicare and Medicaid. So technically this applies to insurance companies, providers, hospitals. Anyone who gets any payments from HHS has to provide for this. Now, so insurance companies have to include and cover transgender procedures changes in their policies. The question that remained is, would self-insured plans have to comply? And the issue and problem is you have to ask, does your TPA receive payments from HHS? And if you have an insurance company that acts as your TPA under a self-funded plan, you may have to comply with this. Now, a Texas federal court issued a nationwide injunction, and this is against the May 2016 regulations, and said there's going to be a stay for this. In the lawsuit, 8 states and 3 private health providers argued that the regulations' interpretation of discrimination on basis of sex, including gender identity and termination of pregnancy, exceeded the HHS authority. In addition, this portion of the regulations violated the Religious Freedom Restoration Act because it didn't provide any religious exceptions to this rule. And the states and providers requested a preliminary injunction, which the court granted, because the regulations are generally applicable for plan-to-plan years beginning on or after January 1st, 2017. The court held that sex in Section 1557 refer to the biological difference between males and females, and the definition of sex discrimination in the regulations to include gender identity went beyond the court's intention. In addition, the court didn't like the fact that there was no religious objection provisions in the law. So let's wait and see what's going to happen. There's probably going to be a hearing on this, but as we speak, there's an injunction against this being enforced. Now, annual adjustment to penalties. And again, some penalties under ERISA will be increased every year. So the maximum penalty for filing a 5500 went from $2,063, and this effective for 2017, to $2,097 if the 5500 is late. So please, if you know any employers are not filing the 5500s, this penalty is astronomical. If you get caught, you could be penalized $2,097 in 2017 for not filing a 5500. So please, and there's a delinquent filer program which is extremely important, very easy, and those penalties can be reduced to next to nothing. But again, they can hold this over an employer. The maximum penalty for filing a SBC went from $1,087 to $1,105. Also, for not providing CHIP assistance notices, the penalty went from $110 to $112. And that's per day for not providing the notices. For 401k plans, the plans with automatic contribution arrangements, the notices, the penalties went from $1,632 to $1,659, and for penalties for failing to provide blackout notices for 401ks when you go from one provider to another, increase went from $131 to $133, and the maximum penalty for failure to comply with ERISA 209 record keeping and reporting notices is still $28. And lastly, for what's interesting, there's a Form M1 if you are determined to be a what we call a multiple employer welfare arrangement. There's an M1 that has to be filed every year. The penalty is now $1,527 a day. And what's interesting about that, there's no way to get around it. There's no delinquent filer program for those. Now, a multiple employer plan is a plan, it's an employer, a welfare plan that provides coverage for unrelated employers. I don't know how many times I've run into that in my practice. Is very prevalent where people get together and all of a sudden they're covering unrelated employers in a welfare plan. So please, this is an extremely important penalty, and make sure your clients know about it. Additional guidance regarding to HRA integration. Amanda, do we have any questions?
We have two questions. The first is, must all group plans with more than 50 lives offer an annual open enrollment, and must previous employees who waived coverage be allowed to enroll?
Yes, there must be an annual enrollment every year. In order to avoid any issues or penalties for not providing health coverage, there has to be an open enrollment every year. That is correct.
Gotcha. And then, is the employer required to provide a new SBC each plan year even if there are no changes?
Yes.
Okay. And that's all we have for right now.
All right, let's look at HRA integration. That's the next. And part of ACA, if you're sponsoring an HRA, in order not to be penalized, the HRA has to be integrated with the group health plan. And what the Internal Revenue Service said is the fact that that means that if you have a single coverage, you can't integrate it and reimburse expenses from your family members if they're not covered by a group health plan. So if an employer signs up and has single coverage from their employer, a plan is HRA is truly integrated if that HRA it only reimburses expenses for that employee. If the employer reimburses expenses for family members not covered by the plan, technically that plan is not integrated. Now, the IRS did release some guidance, confusing people in regard to could an employer single coverage with you if the employee came and said, well, my dependents are covered by a group health plan, and here's evidence that they have coverage under my spouse's plan, can you then reimburse those expenses? And the Internal Revenue Service in this guidance said yes. As long as that other coverage is group health coverage, then that plan that your employer, that HRA that your employer sponsors, will be considered to be integrated. So it can be integrated within a group health plan from your employer or your spouse's employer, and they made it real clear. But again, an employer could not, they have to get evidence that those other dependents are covered by another employer's plan. That's extremely important. So again, as I say, family HRA can be integrated with a combination of self-only coverage for the employee under a non-HRA group health plan, and then coverage for other employers under a non-HRA group health plan sponsored by the spouse's employer. Very clear, and so all cloudiness has been eliminated by this new ruling. Trump's first series of executive orders. These were the first series that were released soon after he got inaugurated in January. And let's go through exactly what he indicated. And this excited a lot of people. So President Trump has issued an executive order regarding his administrative intent to seek a prompt repeal of ACA. In addition, in a separate memorandum, informs federal department and agency heads of President Trump's plan for managing the regulatory process at the outset of his administration. The order states that pending ACA's repeal, the executive branch must act to minimize the law's unwarranted economic burdens. The HHS Secretary heads with responsibilities under ACA are directed to exercise their authority and discretion to waive, defer, grant exemptions from, and delay implementation of any ACA requirements that impose costs, fees, taxes, penalties, or other burdens, to provide greater flexibility in the states and to cooperate with the states in implementing healthcare programs. Once that was released and got publicized, my phone ran off the hook, because the first thing people thought, aha, 1095-Cs. Does this mean we don't have to file the 1095-Cs? Because what that is implying is that they're going to waive all penalties and costs and fees for not filing. So people are asking, do I have to file my 1095-Cs? And my answer is, until HHS, IRS, or DOL releases guidance releasing and waiving all penalties, I'm sorry, but you still have to file them. So no governmental agency has released any guidance yet. Secondly, the memorandum directs all federal department and agency heads not to submit regulations for publication in the Federal Register. Department and agency heads are further directed to postpone effective date of regulations that have been published in the Federal Register, but none have been taken effect until 60 days. And following the effective date delay, agencies to notify the Office of Management and Budget and that raise substantial questions of law or policy. And the memorandum notes that also applies to government guidance documents. Agency statements are generally applicable in further effect. Establish policies, so everything is on hold. Ever since this was released, none of the governmental agencies have released any guidance at all. Everything is at a complete standstill. So please understand that. So far nothing has been released. So there's a freeze in any new regulations. Next, tax treatment of benefit paid by fixed indemnity programs. On January 20th of 2017, the IRS released Chief Counsel Memorandum, as you see the number there. Now, what they indicated was that if you have what we call a fixed indemnity program, what this is that programs sold by Aflac and Colonial, which are voluntary. And basically what they do is they reimburse an employee for certain injuries, illnesses, but it doesn't necessarily have to reflect the actual cost of the expense. So again, the extent amounts are received through an employer-provided accident or health plan are paid without regard to the amount of expenses incurred by the employee for medical care. The amounts are not excluded from gross income because the amounts are not paid to reimburse expenses incurred by the employee for personal injuries. What that means is it's not going to be treated as a medical expense being distributed. So these are, again, your critical illness policies, other policies that pay a fixed amount. So amounts received through accident and health insurance for personal injuries or illnesses are excluded from, again, 104A3. But this exclusion does not apply, however, if amounts are either attributable to contributions by the employer that were not included in gross income or paid by the employer. And what they're saying in this situation is that any salary reduction contributions paid by the employee through a cafeteria plan are treated as employer contributions. So here, many of these companies, these are voluntary policies paid by the employee with pre-tax dollars. If that is the case, any reimbursements received by the employee are supposed to be taxable if they're paid with pre-tax money. That's what that is saying. Now here's the problem with that. Here's the problem. The problem with that is that the employee has no way of knowing, and the employer has no way of knowing how much the employee is reimbursed. Remember, these policies are voluntary. They're individual. But by putting pre-tax contributions, it turns the voluntary policies into employer-sponsored policies. So therefore, these pre-tax contributions are treated as employer contributions. And the issue and problem that everybody's scratching their head is, well, technically, these are considered to be wages, and the employer is supposed to withhold taxes when the employee actually receives these payments. And the employer has no clue that these employees actually received a reimbursement from one of the insurance companies. That's the problem. So because the premiums for the fixed annuity health plan are paid with amounts that are not included in the employee's gross income, the exclusions under 105B and 104 do not apply. Any amounts paid by the plan are included in the employee's gross income and wages, regardless of the amount that any medical expense incurred by the employee. So technically, the employer is on the hook for under-reporting withholding. And there's no way for the employees in the past, for the employer in the past, to figure out how much the employee was actually receiving. That's the problem. Trump's second series of executive orders. These were released last week. First of all, the order is directing that the fiscal year already underway, a federal department agency proposing a regulation is generally must identify at least 2 existing regulations to be repealed. The order provides that with limited exceptions that the total incremental cost of any new regulations will be finalized in the current financial year must not be greater than 0, and any incremental cost of a new regulation must be offset the cost of the regulations being repealed. What that is going to do is it's going to slow down any release of regulations, because more analysis has to be done to see the true cost of what that regulation is going to impose. So the order entrusts the Office of Management and Budget to issue implementation guidance, including processes for determining the cost of regulations, as well as standards for the qualifies as the new offsetting regulations. For future fiscal years, departments and agencies must submit an annual regulatory cost analysis to the OMB with the cost to be managed and controlled, which means this is going to slow any guidance from the government agencies because they have to determine the true cost of any new regulation. Any questions?
We have 2 here.
Amanda?
Yep, or sorry, we have 3. The first, can you explain when an HRA must be integrated with a group health plan, as we've been told the past few years, and when an HRA does not need to be integrated with a group health plan through the CARES Act?
Sure. If it's going to reimburse expenses, an HRA has to be integrated with a group health plan because by itself an HRA does not meet the ACA requirements for being a group health plan. Now the only other time that an HRA doesn't have to be integrated if it's not reimbursing medical expenses, which means it's reimbursing dental and vision expenses. Those plans don't have to be integrated. Another plan that doesn't have to be integrated is if you have a freestanding retiree medical program. Retiree medical programs are not subject to ACA, so therefore those HRAs don't have to be integrated. Okay?
Mm-hmm. Dental. Okay. The next, is there a maximum amount that an employer can contribute into an HRA, and must an employee have access to high deductible plan for the program to be compliant?
It doesn't have to be high deductible. The limit is specified by the employer. So the employer determines what they're, because it's employer money, they decide what the limit is, and they can, again, determine that limit year by year. When I draft HRA plans for my employers, for my clients, I basically say it's up to the discretion of the employer. So every year they can set the limit of exactly how much they're going to make available to those employees. Sometimes it's a few thousand, other times it's much more than that. Now the only exception that, as I explained today, was the limit on the small employer HRA. That's an exception. But again, in that situation, the employer is not sponsoring a group health plan. But the regular HRA you've seen around for the last 10 or 15 years, the limit is specified by the employer, and they can change that limit if they want, year by year if they want. And they can have one limit for those people that have family coverage and another limit for those who have single coverage. Right. Because it's a self-funded plan, HRAs have to be tested for non-discrimination under Code Section 105H. So you can't have an HRA, for example, just for the executives or the highly compensated. You must have it for a cross-section of employees. It doesn't mean you have to offer it to everyone. It just, the group that you offer it to must be non-discriminatory.
Since the employer doesn't know when the employee receives payments from a fixed indemnity plan, how will this issue be resolved? Will employers be instructed to have employees report when they receive such payments?
Well, one thing I didn't mention, I just remember I didn't mention this, is that the general council memorandum doesn't have the force of a regulation. It just shows us what the IRS is thinking. It's not formal guidance, all right? But in that situation, what I would try to do is, moving forward, is talk to your insurance broker who sold you the fixed indemnity program and say, how can we, moving forward, make sure that, one, now premiums and what the quick fix is, any premiums for this coverage would be post-tax. If it's pre-tax, then you have to talk to your broker and talk to the insurance company about getting a record of any reimbursements that your employees receive in order to make sure those amounts are included in their income. We don't know at this point whether the IRS is going to require employers to go back and put into income any amounts of those. It's going to be a debacle. It's going to be because these are generally individual products. So whether the insurance company is going to cooperate with you, I don't know. I haven't talked to insurance companies in regard to this issue. But again, what was interesting about this is many of the insurance companies were actually handing out cafeteria plan documents to their brokers to give to the employees so the employees can actually pay for these premiums on a pre-tax basis.
Okay. On the fixed indemnity plan, would you then recommend that employers, you just discussed that yes, the quick fix is to change the fixed indemnity plans to after tax.
That's a quick fix moving forward. We don't know what the fix yet is passed. So we don't know what the IRS is going to require, and I would think eventually they would have to release regulations on this and saying what the fix is.
Mm-hmm. Okay.
But the employer's on the hook. That's the problem.
Yeah. And then I think our last question, as we're almost out of time, is can you require the insurance carrier to issue 1099s to employees?
Well, the problem is it's an employer-sponsored plan. It's not 1099s. They have to include it in W-2s. That's the problem. It's an employer-sponsored benefit. So there has to be some way of the employer working with the insurance company to get a report of what those amounts are.
Mm-hmm.
So that's the issue, and that's the problem, because once you take a voluntary benefit and you include pre-tax contributions, those are treated as employer contributions,
Mm-hmm.
and you're turning a voluntary benefit now, because to be a voluntary benefit, the employer cannot endorse it.
Yeah.
By putting employer contributions in a plan, you're endorsing it. That's the issue. That's the problem.
All right. Well, that's all the questions we have right now, and that's all of our time for today. Thank you guys so much for joining us. Like I said, you'll be having a schedule. Yep.
Right.
You'll have a schedule in your inbox soon.
So probably next week or so. So we're going to try to do some new things. So look forward to that. Okay. Take care, everybody, and we'll see you in a few weeks.
All right. Thanks. Bye.